Intu Properties, okay? This one used to be called Capital Shopping Centres, and of course prior to that it used to be called the big part of Liberty International. Remember its roots, it came from Donald Gordon, who built a portfolio of properties in the Liberty stable in London, and then it kind of broadened and split, and we'll have to talk about its corporate history. Remember, its core assets are these mega shopping centres, regional shopping centres around the United Kingdom, and it's done a number of infill deals since then. Market capitalization 89.1 billion rand. Okay, so that's sizable. It's part of the Aussie 40 and all of that. It's got a South African shareholder base. It's got a UK shareholder base. I think, and I'm not going to, put my name by these yield numbers, but I think it has a yield, historic yield from prior distributions of around 4.43%. It distributes in pounds, and then those get converted for South African shareholders into rand distributions. Okay. So talk about its history, its assets, and why you think this is a good one.
So this is really a pure play regional UK shopping centre. So it's 100% retail. You're getting a broad exposure to the UK economy and the UK shopper. What has weighed on it recently has been this concern about Brexit and the impact that will have on the...
Now, for those who don't know, these sort of nonsense words like Brexit, what is that? That's Britain exiting the Eurozone.
Correct,
or the European Union.
Yes, and sort of all the benefits that come with it,
Brexit,
access to free trade. That's right, would have a particular impact on the London property market because of the impact on London as a financial centre, but then more broadly on the UK economy as well. And that's really weighed on these stocks and the performance.
But it's like stupid because no one, it's like, to leaving the Eurozone, I always say it would be comparable to like voting to relegate yourself from the Premier League.
I agree with that.
But there's going to be a referendum now in June, and there is at least some risk that there could be some upsurge in jingoism, and then the Brits decide they want to get out, and then you would say there would be a net negative impact for occupancies and for the British economy generally.
Yeah, that's right. Just overall demand, as we said, for property. So that's, I mean, the underlying fundamentals I think are good. They came with results. There has been concern, I think, about the health of the UK consumer and the sort of shopping experience. Are people moving more to the internet? Will there be long-term?
What is your sense of that? Not a problem.
I think these property owners are adapting. So what they're having to do is make their malls and venues more of a destination. So more entertainment, more food that is destination driven, get the shopper to stay for longer. So actually the recent results were, I think, better than expected. Good rental revisions. They're getting good increases on new rentals, better occupancy, and some actual underlying turnover growth, which feeds into rental
Which would
income.
obviously play to the bigger players. So some of the sort of secondary crummy centres might battle, but if you're looking for a certain item and you want to go and you've had an online check already, you'd go to the big store. Okay, let's look at the share chart. Now, what's going to be reflected there is a benefit from the weakening of the rand to the pound, because that's what we're talking about here, something which really holds its value there and which then goes up if the rand weakens.
Yeah, so and you get the distribution growth as well. So it actually, if you convert it to pounds, the performance has been quite lackluster. Which reflects, I think, some of the concerns that we've been discussing. So, but I think in the short term you have to take a call on your view on this Brexit and referendum.
Okay, well then let's go to hot or not, because what are you implying? That if you thought there would be a real risk of a no vote or a leave vote, then you would avoid this one for sure.
Yes.
But what if you had the opposite view, that there was no likelihood of a no vote? Then you might buy them now because you take advantage of the uncertainty and then they potentially pop higher.
Because I think it's a 50-50 sort of, and it's priced at that level, the probability. So, and I think there will be a reasonable recovery. You've seen also just the EU and their cut in yields. You're seeing the share prices recover a little bit already. So if you have the view, that Mark Carney will keep rates stable.
Mark Carney, by the way, that's his real name, not George Clooney.
No. So that will keep rates low, and I think given that they've performed poorly, they could move nicely from these levels.
So anyway, here we go for the record. I'm of the view that long-haired, loudmouth Boris Johnson is just talking out of the wazoo. That's not going to happen. There's going to be a resounding vote to stay in the EU. I don't know why I'm so certain of this, but I'm going to go with hot on Intu on account of that.
And I share that view, so basically concur.
Excellent. Hot on Intu. Right.